Hey fellow REIT investors, welcome back to the channel. Today's video is a deep dive into CapitaLand Integrated Commercial Trust, or CICT. It might surprise some of you when I say that CICT is not a REIT I analyze in depth very often. Not because it isn't important, but because it has traditionally been one of the most stable and predictable REITs in the Singapore market. In fact, the last time I did a proper deep dive on CICT was due to a specific event, the acquisition of Ion Orchard, when there was something material to unpack. Even then, I didn't focus too much on CICT's existing portfolio, leaving CICT to just quietly do its job. And that's exactly why I think it's worth revisiting now. As we head towards the end of the year, I wanted to step back and look at CICT again, not because something dramatic has happened, but because it remains an important holding for many investors. Some of you have held it for years. Others may be considering it for the first time, but keep hearing that it's a core REIT without ever seeing a proper, comprehensive breakdown. So this video serves two purposes. For existing investors, this is an update, a chance to reassess CICT as it stands today, based on recent operating performance, capital management, and how the portfolio has evolved. For newer investors, this is meant to be a complete guide, not just what CICT owns, but how it actually performs, what drives its income, and what its limitations are as an investment. We'll break the REIT down by its main business segments: Singapore office, Singapore retail, integrated developments, and overseas assets. Then we'll move beyond the properties and talk about capital management and the role of its sponsor, before addressing the key risks and wrapping up with how I think about CICT today. As always, a reminder that this video is for informational purposes only and not financial advice. Always do your own research and consult a licensed advisor before making any investment decisions. I own some of the REITs discussed, but remember, what works for me might not work for you. Alright, let's start by looking at what CICT actually owns. Big picture, what CICT really is. Before we go sector by sector, you need one mental model. CICT is not an office REIT. It's not a retail REIT. It is a blended cash flow machine, dominated by Singapore, with the mix showing up clearly when you look at where gross revenue is coming from. In 1H 2025, CICT's revenue contribution was largely Singapore, about 95%, with the rest split into Australia office and Germany office. Within that, the biggest chunks come from suburban retail, downtown retail, and CBD office, with hotels and convention exposure also present. So when people argue about CICT like it's an office or retail call, they're already starting with the wrong framework. CICT is really about Singapore consumption, Singapore jobs, and Singapore urban nodes, then a small overseas sleeve for diversification and optional upside. Now let's drill down properly. Singapore office, the quiet engine room. CICT's Singapore office exposure is anchored by well-known towers across the CBD and city fringe ecosystem. Names like Capital Tower, 6 Battery Road, Capita Green, and now, increasingly, Capita Spring as the structure changes. And if you want the cleanest results-driven view of office performance, you look at three things: occupancy, rents, and rent reversion. On occupancy, CICT's office portfolio held up strongly. In 1H 2025, management disclosed office committed occupancy in the mid-90s range, and overall portfolio occupancy was 96.3% as of June 30, 2025. By 3Q 2025 updates, we get more granular color. CICT's Singapore office portfolio committed occupancy was disclosed at 97.7% as at September 30, 2025. On rents, the office story is not explode upward, it's inch upward steadily, which is exactly what you want for a core REIT. CICT's business update showed average rents of the Singapore office portfolio rising from $10.72 PSF to $10.92 PSF per month from end September 2024 to end September 2025, roughly a 1.9% year-on-year increase. On rent reversion, the numbers were positive and meaningful. In 1H 2025, year-to-date office rent reversion was 4.8%. By the 3Q 2025 business update, year-to-date office rent reversion was disclosed at 6.5%. Now, let me make this real with a property-level story that matters going forward: Capita Spring. Capita Spring has been an important asset for a while, But the big earnings update pivot is that CICT completed the acquisition of the remaining 55% interest in the Capita Spring office component in August 2025 for $1.045 billion, based on 55% of an agreed property value of $1.9 billion. That matters because it changes the office engine room in two ways. First, it increases the direct income contribution going forward because the interest becomes 100% from late August 2025 onward. Second, it affects capital structure, because funding this pushes gearing up and makes interest rate discipline more important. So how attractive is the Singapore office as a sector right now? The market reports on the sector agree on one thing: the supply is tight in the CBD for the next couple of years, and with return to office mandates, rentals may continue the uptrend in 2026 by about 5% on average. My quick take on this sector? For CICT specifically, office looks like the stable, quietly compounding piece, not the hero. When your average rents are ticking up and you're renewing at positive reversions into a positive macro trend, without occupancy cracking, that's a good outcome. But it's still an office market, and office has supply cycles. So the attractive part isn't that you're going to get explosive growth. It's that CICT is positioned to take small wins consistently while keeping occupancy high. If you own CICT as a core holding, that is exactly the kind of office exposure you want. Singapore retail. The part everyone talks about, but details matter. CICT's retail exposure is the most visible part of its portfolio, because it owns assets you've actually walked into. It also explains why CICT often behaves like a Singapore consumption index. The retail portfolio spans two big clusters: downtown malls and suburban malls. Downtown includes names like Plaza Singapura, Funan, Raffles City Singapore, Bugis Junction and Bugis Plus, the Atrium at Orchard, and of course Ion Orchard as the high-end anchor in the story. Suburban includes Badak Mall, IMM Building, Junction 8, Lot 1 Shoppers Mall, Tampines Mall, Westgate, Bukit Punjang Plaza. Now, a results-driven retail deep dive is simple. You track tenant sales, shopper traffic, retention, and rent reversion. And then you ask, are the numbers being propped up by one asset, or is the portfolio genuinely healthy? In 1H 2025, retail rent reversion was 7.7% year-to-date, and retail retention rate was disclosed above 80% year-to-date, indicating healthy leasing stickiness. By YTD September 2025, downtown rent reversion was 7.4% with retention around 80.8%, while suburban rent reversion was 8.4% with retention around 78.7%. Total retail rent reversion for the retail portfolio was 7.8% year-to-date. That split matters, because suburban malls are the daily needs engine, and when suburban rent reversion stays strong, it tells you CICT's bread and butter malls are still doing what they're supposed to do. Now let's talk tenant sales and traffic, and here's where I want you to be careful as an investor. Ion Orchard can distort the headline. In 1H 2025, tenant sales and shopper traffic were higher year-on-year largely due to the inclusion of Ion Orchard. Excluding Ion Orchard, tenant sales PSF was basically flat to slightly down in that specific window, while shopper traffic still grew modestly. By YTD September 2025 updates, management again highlighted that the increase in tenant sales was mainly due to Ion Orchard, and that excluding Ion Orchard, tenant sales PSF for the retail portfolio increased by 1.0% year-on-year, while excluding Ion Orchard, shopper traffic grew by 4.5% year-on-year. So what is the real story? The real story is not Ion is amazing. The real story is, even after stripping out the trophy asset effect, the broader retail portfolio is still holding up. Now let's look at two property highlights that actually matter for forward performance. The first is IMM Building. IMM is not just another suburban mall, it's a regional outlet destination. In 1H 2025 materials, management highlighted that the Phase 3A space had been handed over to tenants, and that this strengthening of IMM's position as a regional outlet destination is expected to progressively contribute from 3Q 2025. This is the kind of story that sounds boring until you realize what it means. You're not praying for macro to improve, you are actively creating higher quality space and pushing your asset into a stronger positioning category. The second is the suburban reinvestment story. Lot 1 Shoppers Mall. Management disclosed an IA designed to create about 15,000 square feet of new net lettable area by leveraging URA's surplus car park conversion scheme, while keeping the mall operational. The project includes more convenience offerings and better connectivity via a new sheltered link, with pre-commitment above 70% and a target ROI above 7%. This is the CICT retail playbook in one sentence: maintain traffic, upgrade experience, remix tenants, and squeeze better rents without shutting the asset. So is Singapore retail attractive? In my view, for CICT, yes, but with a more measured pace mindset. Management itself guided that retail rent reversions are projected to remain positive but at a more measured pace for the rest of 2025. That sounds reasonable. This is not a bubble retail market. It's a mature market, with steady consumer spending and periodic macro jitters. If you're a long-term dividend investor, positive but measured is a feature you'd love. Before we move on, a quick pause here. If you're finding this deep dive useful, do give the video a like. It really helps the channel reach more long-term income investors like you. And if you'd like to support the channel more directly, I've also opened up the Dividend Uncle membership. It's mainly for those of you who want to support the work, and I will try to publish insightful videos earlier on Friday for members to thank you for the support. To all the new members who've joined recently, Cilantro, Tom, and Lawrence Poe, welcome. I really appreciate the support. Now, let's move on. Singapore Integrated Developments, the real mode is in the mix. Now we talk about the part of CICT that is easy to underappreciate: integrated developments. Integrated developments are basically assets that blend retail with office, and sometimes hospitality and transport adjacency. In CICT's case, you can think of these as the mode assets because they're harder to replicate, and they sit on strategic nodes. Raffles City, Singapore is the obvious example. It's a retail asset, an office tower, and it plugs into the city's demand flow. Funan is another modern example: more experiential, more tech lifestyle, more people go there for a reason. From a results standpoint, management shows integrated developments both as their own revenue bucket and also as part of the retail/office operating metrics depending on how they classify components. In 1H 2025, integrated development portfolio gross revenue and NPI were disclosed as growing modestly year-on-year, and overall like-for-like portfolio growth remained positive. But the deeper story is how the integrated sectors helps in leasing resilience. When you have an ecosystem, office workers feeding retail, retail experience anchoring footfall, transport connectivity feeding everything, your occupancy stability tends to be better, and your re-tenanting tends to be less painful. And here's a micro story from the 3Q 2025 update that signals active curation. Management showcased the ongoing injection of vibrancy with a new wave of F&B and lifestyle openings across properties like Funan and Raffles City. While vibrancy doesn't sound like earnings, but it is earnings. Because mall traffic is what protects tenant sales, which protects your rent, which protects your DPU. So is the integrated segment attractive? For a core REIT, integrated assets are the crown jewels. They don't always show up as fast growth in one quarter. They show up as resilience. Your worst quarters are not that bad, your occupancy stays high, and your ability to push rents remains intact across cycles. That's why people call CICT a core REIT in the first place. Overseas, small, but it can move the needle when timing is right. CICT's overseas sleeve is mainly office exposure in Germany and Australia, and it's small relative to the Singapore portfolio. In 1H 2025, overseas office exposure contributed a low single-digit share of gross revenue. So why does it matter? Because it introduces two things: diversification and project timing risk. Let's start with Germany, specifically Galileo in Frankfurt. This is a key story because it's undergoing IA works, and the earnings impact it's staged. In the 1H 2025 materials, management highlighted the IA nearing completion, progressive handover to the European Central Bank, and that Galileo is expected to contribute more meaningfully from 2026. In plain English, that means, short term, you may see some noise or dilution during works. Longer term, you are repositioning the asset to a more modern workplace profile with more stable tenancy. Australia office is the other part. It tends not to dominate the narrative, but it matters in periods where Singapore office is soft and Australia cycles differently, or vice versa. Is overseas attractive? I would call it strategic optionality, not the core thesis. The overseas sleeve should not be the reason you buy CICT. It should be the reason CICT sometimes surprises you on the upside when an asset cycle turns or a redevelopment completes at the right time. Up to this point, we've talked almost entirely about what CICT owns, but a deep dive on a REIT like CICT cannot stop at properties alone. Because two REITs can own equally good assets, operate in the same markets, and even report similar occupancies, yet deliver very different outcomes for unit holders over time. Capital management, gearing, refinancing, and why size matters. Let's talk about the part of CICT that doesn't show up in glossy mall or office photos, but quietly decides whether your DPU grows, stalls, or gets squeezed. Capital management. As at September 30, 2025, CICT's aggregate leverage was 39.2%, with total borrowings of about 10.1 billion Singapore dollars. Its average cost of debt was 3.3%, interest coverage ratio was 3.5 times, and its average term to maturity was about 3.9 years. On top of that, CICT carries investment-grade issuer ratings of A3 from Moody's and A from S&P. If you compare the capital numbers against other REITs, you can see the advantage CICT has just because of its size. Because in the REITs market, size isn't just bragging rights. Size is bargaining power. Here's what I mean. When a REIT is huge, has a long operating track record, and has high-quality assets that banks actually want to lend against, the borrowing conversation changes. You're no longer negotiating like a small tenant asking for a rent discount. You're negotiating like the anchor tenant. In CICT's case, the funding mix tells you it's operating at a scale where it can tap multiple channels, not just whatever bank facility is available. This matters because refinancing cycles are where weaker REITs get exposed. In a rising rate environment, who can refinance cheapest becomes a competitive advantage. And in a falling rate environment, who can lock in those lower rates becomes a competitive advantage. Either way, scale and credit standing typically translate into tighter spreads and better access. Now, one detail some investors might find disturbing. The percentage of fixed-rate borrowings shifted from 81% at June 30, 2025 to 74% at September 30, 2025. That doesn't automatically mean riskier, it can also reflect timing. When rates are easing, some REITs purposely allow more floating exposure to benefit from falling benchmarks before refixing later. But it does mean we should watch the direction of Singapore rates and track whether CICT continues to actively manage that mix rather than letting it drift. Sponsor strength. Why CapitaLand has skin in the game. With CICT, you're not just buying a collection of properties, you're buying into the CapitaLand ecosystem. CapitaLand Investment has, for years, positioned itself as an asset-light capital manager. Its business model is built around raising third-party capital, managing funds, recycling assets, and earning recurring fees. Within that strategy, listed REITs are not peripheral. They are core platforms. CICT is one of the flagship vehicles in this listed funds platform. As at late 2025, it sits at roughly $27 billion to $28 billion of assets, with CapitaLand retaining a meaningful stake of around 21%. That stake matters, because it directly aligns incentives. When CICT is stable, liquid, and able to grow distributions over time, the sponsor benefits not just from its equity stake, but also from the credibility and scale of the platform. This is why sponsor support in CICT tends to show up less as dramatic rescues, and more as structural advantages: access to deal flow, institutional relationships, operating platforms, and the ability to execute large, complex transactions without destabilizing the balance sheet. The Capita Spring transaction is a good illustration. Rather than a simple asset transfer, it reflects a broader capital recycling approach, moving assets into a perpetual listed vehicle while retaining strategic influence and redeploying capital elsewhere. That's consistent with an asset manager mindset, not a short-term seller. Of course, sponsor strength is not a free lunch. It requires discipline to ensure acquisitions are priced sensibly and accretive. But in the hierarchy of Singapore REIT sponsors, CapitaLand is widely regarded as one of the strongest precisely because its platform is built for the long term, and CICT is an integral part of that platform. Key risks, the few that matter, and why they're contained. CICT does face risks, but they are not the kind that threaten the stability of the trust. They mainly influence how fast distributions can grow, not whether they are sustainable. The first risk is interest rates and refinancing. While market expectations now lean towards rate cuts, the path down is unlikely to be smooth. CICT's gearing sits just under 40%, which means financing costs still matter. That said, this risk is well contained. Debt maturities are spread out, a large portion of borrowings is hedged, and CICT's scale and investment-grade profile give it access to cheaper funding than most peers. Higher for longer rates would cap DPU growth, but they are unlikely to impair distributions. The second risk is retail normalization. After several years of post-pandemic recovery, rental growth is expected to moderate. For CICT, this is a manageable slowdown rather than a structural issue. Its retail income is anchored by dominant suburban malls that capture necessity spending, not discretionary splurges. As a result, the more realistic risk is slower rental reversions, not falling occupancy or collapsing cash flows. The third risk is capital allocation discipline. With a strong sponsor and a large platform, CICT has access to meaningful acquisition opportunities. The risk lies not in access, but in execution, ensuring that acquisitions are well-timed, sensibly funded, and accretive over the long term. This is the risk investors should monitor most closely. However, CICT's historical approach has been measured, and its balance sheet provides a buffer against missteps. Taken together, these risks do not undermine CICT's role as a core REIT. They define the boundaries of its upside, not the durability of its income. The Dividend Uncle's take: why CICT works best as a core holding. Let me be very direct about this. CICT is not a REIT that excites everyone. Some investors look at it and see a relatively lower yield, modest DPU growth, and a price that rarely feels cheap. Compared to smaller, higher-yielding REITs, CICT can look almost boring. And if your objective is to maximize yield today, it may not be the most attractive option on its own. But that's also missing the point. CICT is not designed to be the yield booster in your portfolio. It is designed to be the foundation. Its job is not to stretch for returns. Its job is to deliver steady, resilient income through cycles, supported by dominant Singapore assets, disciplined capital management, and a sponsor that treats it as a long-term platform rather than a short-term trade. Once you accept that role, CICT makes a lot more sense. Instead of forcing a core REIT to do something it's not meant to do, the more effective approach is to pair it with satellite holdings that provide higher yield or tactical upside. These could be smaller REITs, overseas exposure, or more cyclical sectors, sized appropriately based on your own risk tolerance. So if CICT feels too stable or not exciting enough, that's not necessarily a flaw. It's often a sign that it's doing exactly what a core REIT is supposed to do. And in uncertain markets, having a boring core is sometimes the smartest move you can make. So that's my updated take on CICT. It's not the most exciting REIT, and it's not trying to be. But after stepping back and looking at the assets, the numbers, the balance sheet, and the sponsor, it's clear why CICT continues to be such an important holding for many long-term income investors. As always, what matters isn't just what you own, but why you own it. If this deep dive was helpful, do give the video a like, and feel free to share your thoughts or questions in the comments, especially if you're already holding CICT or still evaluating it. Thanks for watching, and I'll see you in the next one.